You're listening to AI Prism from Seoul Economic Daily.
It's Thursday, May 7th. I'd like to share some thoughts about Securities daily. Imagine holding prime European real estate, right? Leased directly to a government for the next decade, but still triggering a default.
Right. It sounds completely counterintuitive.
Exactly. But that is the exact scenario playing out right now in Korea's capital markets. We are taking a deep dive into the Global REIT default today.
Yeah, the key asset here is the finance tower in Brussels, Belgium. It is leased to the Belgian government through December 2034. That generates 105 billion won, or 72 million US dollars in annual rent.
Which is a very solid income stream, but an April 2026 cash trap forced a default, right?
Yes. A cash trap is a covenant requiring all cash flows be retained for debt service rather than distributed, so the default happened despite that steady rent.
Oh, wow. And what really stands out in the sources is the credit rating shopping controversy this exposed.
Definitely. Nice credit rating actually declined an A upgrade for them, so the REIT just terminated the relationship and went straight to Korean Investor Service and Korea Ratings.
And let me guess, they got the A rating.
They did. Both granted the A rating, even though the REIT's quantitative metrics map to a BBB rating on their own internal grids.
Wait, so the math clearly states this is a BBB asset, but the agencies upgrade it to an A anyway. I mean, how does that methodology actually work?
Well, it relies on a methodology gap between the quantitative grids and final ratings. Qualitative scores, like business stability derived from that Belgian government lease, can completely override weak quantitative metrics.
Because the agencies are incentivized to win the business, so they lean on those qualitative factors.
Right, and this is a systemic practice. 7 out of 10 A-rated Korean REITs share this exact rating gap.
So if you were an institutional investor tracking Korea's markets, this illusion of safety isn't isolated to real estate. We see a similar pattern of delayed risk when we look at how Korean entities fund themselves offshore.
Right, you're talking about Korean paper,
Yeah.
or KP. These are foreign currency bonds issued by Korean entities.
Exactly, and there's a record 65.04 billion US dollars, or roughly 96 trillion won, maturity wall hitting in 2026. Why is so much debt coming due all at once?
It traces back to the 2022 rate environment. Issuers actively concentrated their borrowing in short-dated paper to avoid locking in high long-term yields.
So now all that debt is maturing at the exact same time.
Yes. And compounding this supply risk is new issuance from government-linked entities. For example, the ceiling for foreign exchange stabilization bonds was recently raised to 5 billion US dollars.
And just for clarity, those are sovereign-backed instruments used for managing currency reserves, right?
Correct. Plus the National Pension Service, a state pension fund managing 1,700 trillion won, or 1.16 trillion US dollars in assets, might directly issue foreign currency bonds.
So the market is going to have to absorb a heavy supply influx, and the market plumbing is already struggling to digest isolated distress. Look at what happened with Global REIT's listed bonds right after their default.
The fallout was immediate. The listed bonds collapsed 50% in price.
Half their value just wiped out.
Yeah, and trading volume surged up to 27 times the daily average.
Which has sparked an active regulatory debate over whether bond trading halts should be introduced, right?
Exactly. Without halts, you just let the market crash until it finds a bottom. But artificially halting trading freezes investor liquidity when they need it most.
Regulators are really balancing the need to stabilize market plumbing against the severe risk of trapping capital.
Yeah. And speaking of market plumbing stress, that brings us to the retail and institutional ETF sector. Korea's ETF market is approaching 450 trillion won in assets.
Which is a huge number. But the quality of liquidity providers, or LPs, is visibly deteriorating. These are the market makers required to keep ETF prices aligned with their underlying assets.
Exactly. The count of C-grade brokers operating as LPs has hit a post-2020 high. This infrastructure strain is a very specific near-term risk.
Especially because single-stock leveraged ETFs are scheduled to launch on May 22, 2026. Think of an ETF liquidity provider like a shock absorber on a car.
Yeah, that's a perfect analogy.
Right now, the market is swapping out heavy-duty shocks for cheap C-grade alternatives. When those highly volatile single-stock leveraged ETFs go live next May, those cheap shocks will be tested.
Absolutely. If you are trading these products, you really need to consider how this compromised liquidity infrastructure will handle that resulting volatility.
That's today's AI Prism Securities Daily. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI Prism is a Juan Ifore award-winning series. We'll be back tomorrow.
You've been listening to AI Prism from Seoul Economic Daily.